Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi folks, welcome to Centennial Wealth third quarter market update. I've got a lot to share with you, so let me just get started. First of all, as you can see, this is the indexes year to date. You can see that the S&P 500 is up 3%. The Dow is down 3%. But look at the NASDAQ, up 27%. And that's coming off last year when it was up 35%. So can't argue with this. You've heard me share this in the previous updates. The big story is basically those top 5, 6 tech stocks, right? Really driving all the gains. This is just interesting. You look at the price of the market to its revenue. All right. Now, a lot of people like to look at this versus the earnings because you can't manipulate sales. You can maybe, with some accounting adjustments, manipulate the bottom line, but you can't manipulate sales. And you look at it right now, price to revenue is getting close to like 7 times. That's high. The last time it was this high is going back to the tech bubble in 2000. And then you look at the price to book. Now, book value of a company is its equity. You take its assets less its liabilities, it has its equity. Now, historically, if you look at this, it's basically, the price of the stocks have basically traded at maybe 2-3 times its book value. Look at it now, though. It's getting close to 10 times its book value. So to say the least, and again, the last time it was this high was back at the 2000 tech bubble. So to say the least, things are getting very frothy. We haven't seen this divergence. If you look at what the tech sector is doing, which is basically the best sector, and compare it with the worst sector, the spread is basically 76%. We haven't had a spread like this since the Great Depression. So there is a wide gap between some sectors that are doing real well and other sectors that are absolutely doing terrible. This is just the S&P 500, the last 1 year. You can say in the beginning there, that last quarter of 2019. Now you got to remember, if you go back 1 year ago in September, we were just coming off 3 quarters in a row of negative year-to-year earnings growth. I thought that was a good time to get defensive. But then what did it do? It just kept going up for, during that last quarter of the year. We got into this year, was still peaking, hitting all-time highs. And then what do we get? This big market correction or pullback with the pandemic. And then you can see it's been steadily on the rise. Now, having hit at the end of August, basically hitting all-time highs again. And then in September, wow, what a wake-up call. Took a step back. That's not unusual for the month of September, as you can see here. September has historically been probably the worst month of the year. And then usually once you get past September, or you get October and December, as you can see, it kind of starts to get a little bit better. And then you get that December bounce right around the holiday season. But all things are different, right? I mean, we're in a whole different environment now than I would dare say we've been historically. So, I think it's anybody's guess what the fourth quarter is going to look like. The S&P 500 is becoming very uncorrelated with itself. You got the S&P 500, and then you look at, the S&P 500, which should be evenly weighted. Okay, that's giving every stock in the 500 an equal weight, or like 0.5%. And, there's a correlation there. Well, that correlation right now between, what the market is saying they're all doing and that equal weight hasn't been this high since, again, the last tech bubble. For the first time, as we got into September, we had more companies hitting their 52-week lows than were hitting their highs. It hasn't been like this in months, and now all of a sudden we get into September and we're starting to see this. I just shared with you earlier about the tech stocks. If you go back to that tech bubble in 2000, all right, right at the peak when it burst, what are the top 5 tech companies at that time? Microsoft, GE, Cisco, Intel, and Walmart. And they made up, pretty close to about 19% share of the S&P 500 in market cap. But look at it now with the top 5: Microsoft, Apple, Amazon, Alphabet, and Facebook. Look, it's almost like 25% of the S&P 500. So just think about that. 25% of the entire S&P 500 is being made up by those 5 tech stocks. This is just the S&P 500 versus the world index, the VEU, which is basically everybody else except us. You can see over the last 2 years, our markets, for the most part, correlate right along with the world. I've said this before, I'll say it again, we are much more globally connected than we realize. So you can't have, when we hear things going on overseas, maybe recession, slowdown, pullbacks, shutdowns, it's only a matter of time before that affects us as well. So, you look at this, it was tracking pretty close, and then of recent, there's been kind of a gap. And so, I've said this before as well, usually if their market's either going to come up to meet ours or ours is going to come down to meet theirs. GDP growth, you can see the first quarter this year dropped 5% because the pandemic only affected basically the last 2 weeks in March. And then that second quarter, dropped 31%. Now, the last estimate I've seen for the third quarter is it's bounced back 32%, but you got to understand, when it loses 30%, when you get back from the quarter of 30%, all that meant is it popped back up 10%. We're still down 20% from where we were at. Unemployment, you can see for the last 10 years, it was trending downward for the longest time. And then what do we get? This pandemic spikes up to almost 15%. And now it's dropped. It's getting better. We're hearing the news that more people are getting back to work. But folks, just because it's gotten better, I like to look at things at where they're at. Right now, we're still above 8% for unemployment. All right. And then if you look at this chart, this is a concern. That blue is the unemployment. That yellow is jobs that have been permanently lost. You can see that's on the rise. That's above 3% right now. What's that going to look like? Are we going to continue to see more permanent job loss? And if that settles up, permanent job loss settles around 5-6%, well, that's not good for our economy. Inflation, the last 10 years, again, Feds continually scratch their head because we never did see any inflation bust above the 2%, which is what they target all the time. You can see with the pandemic, it dropped down to nothing, and now it's had an uptick. It's at about 1%. So the Feds came out in September, and they've thrown a lot of money at this thing to get the economy going. But the interesting change in policy now, they've always wanted to keep unemployment low. They've wanted to keep inflation in check at 2%. And now they're kind of changing up the game. Jerome Powell comes out, and I'll just quote this. He says, "It will be appropriate to maintain this target range." Now, what they mean by this target range is they're going to try to keep interest rates basically at 0 for the next 3 years. All right. So they're going to keep this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2%, is on track to exceed 2% for some time. So what are they saying here? They're saying they want to get maximum employment, but they're expecting and desiring that inflation go above 2% now. Now, why would they do that? I suspect the reason a lot of this is coming out is because they know it's going to go above 2%. And they just don't want us to panic about it. They pumped so much money into this economy, and eventually that's going to, make its way into, demand for goods, and prices are going to rise. They know that inflation is coming. So they want us to believe that that's going to be a good thing when it comes. Now, what they're trying to say is, well, we've lived with such low inflation for so long, we can live with some, inflation being over that amount to kind of average it out over time, because having 2% inflation on average over time is a good thing. Folks, I'm not sure it is, and I don't think I think they're changing policy is simply because they're running out of arrows in the quiver, and so they're just trying to get ahead of what is going to be perceived as something negative, and trying to make us believe that it's going to be a good thing. The truth of the matter is, when you have high inflation, people have less money in their pockets. And if they have less money in their pockets to spend, that's not good for corporate earnings. That's not good for the market as a whole. The same thing with unemployment. If you have more people unemployed and they don't have their jobs, that's less money they're spending in the economy. Again, less on earnings, and accordingly for the market. So here's their expectation of interest. You can see 2021, 22, 23. They expect it, for the most part, the Fed's expect it to remain where it's at, and it probably not going to see an increase for at least 3 years out. U.S. wages and salaries growth, you can see for the last 10 years, pretty consistent. Looks like averaging right around 4%. And then with the pandemic, it dropped to nothing. It's at zero right now. All right. So basically, we've got what's happening right now. You got zero wage growth happening. But somebody that's at least still got their job, they're probably figuring that's a good thing. Crude oil, wow, this is, it went into negative territory. I've talked about that previously. I won't talk again, but, you can see that the price of barrel is just kind of hanging around $39, $40 a barrel. And, I've said this before, oil companies generally can't make money until it's at least at $50 a barrel. So, this is turning out to be long and drawn out. And I'm not sure, those oil companies that find themselves highly leveraged are going to be able to survive this. They can't not make money for long periods of time without continuing to borrow. And I'm not sure banks are going to be too eager to want to borrow in that sector right now. So this is something, it's great for us at the gas pump. Not so great for energy companies. Now, some of these larger energy companies that have bigger war chests, they could probably weather this out a lot longer. But I dare say we're probably going to see a lot more bankruptcies on the rise as this thing drags on. This is just CRB Commodity Index. It's just a basket of 19 commodities that it tracks. You can see back in April of 2016, it had taken a historic low. Was bouncing along there, as you can see, and then with the pandemic, just took a greater drop than that. Now it's back a little bit, but it's still at what was the historic low in 2016. So commodities absolutely are taking a hit. Gold, silver, what a bright light though, for the last year. When people get fearful of what's happening in the market, it tends to be a safe haven. As the dollar has downward pressure on it, gold typically has a good uptick. But you can see here, if you look at the negative yielding debt that's out there, gold is pretty much tracking with it on the upside. So as that grows, I expect gold to continue to do very well. This is interesting, the gold to silver ratio. Anytime we've seen that ratio dip to 80, it means that the gold to silver ratio gets less, meaning silver actually has a better chance of growing than gold does. Okay, so silver's been very disappointing in recent months, but I dare say it's starting to have its say now. And as you can see, it just dipped at 80. And if history's any precedence, I think we're going to see silver and gold do well, but I think silver has an opportunity to actually do better than gold in the coming months. Another bright light in this economy right now is real estate. With these low interest rates, people are able to afford a lot more house for their money. That's a good thing. But with the construction industry, needing so much as far as labor and not having all the help they need, supply of houses is actually down. So I think you're going to continue to see real estate, at least on the residential side, do very, very well. Now, I'm not so sure with this new normal that that real estate is going to be in the cities. It's probably going to be in the urban areas. the suburban areas where, it's just outside the cities. So, I think that real estate's going to do really well. I know in our greater Grand Traverse area, the inventory supply is not far off that, just about around 3.5 months. Historically, it's been usually around 5, 6 months. So you got half the supply that you normally have for houses out there. That bodes really well for real estate. Personal savings rate. Why do we track this? Well, if people are saving money, they're not spending. Again, 70% of our GDP is consumer spending. So if they're saving and not spending, that's not good for corporate earnings. That's not good for the market in general. And you can see it spiked up in the pandemic and has come down, but still hovering, almost twice where it's been, during the last recovery. This is the U.S. dollar index. Since 1973, it compares our currency with all the other world currencies, and they kind of baselined it at 100. You can see recent that it's dropped from 100 down to like 93, 94. That's, again, I think, as I said, it's been good for gold. But it also makes our exports cheaper. So it's good for our manufacturing, but I dare say I don't want to see this be a continued thing on the downward, because one of my big fears is with all this money that the feds are printing or basically pumping into the economy, how much more is that going to devalue our currency compared to other currencies? Right now, this is not a good sign. Hopefully not something that's going to last anytime long, so we'll continue to watch it. U.S. consumer sentiment, who can argue that pre-pandemic, consumer sentiment was very high. Again, we had very low unemployment. Everybody was working, everybody was feeling good, and then what did we get? We got this pandemic. So sentiment dropped significantly. But what's interesting is we're not seeing it spike back up. That concern, consumer sentiment, and that concern is still out there. Why is that such an issue? Well, if the consumer confidence is not good, that means people are holding back possibly on spending. And again, if they're not spending, that affects earnings, that affects the market as a whole. Small business optimism, again, pre-pandemic was hitting all-time highs, and then with the pandemic took a significant loss. Again, not spiking back to where it was at. This is the one that we're gonna need to see in the long run. How many of these small businesses didn't make it through? How many right now, like I think of the restaurant industry, are hobbling along right now, seeing how just trying to live another day. But if we get a second wave with this virus and some more shutdowns and pullbacks, and I just don't think they're going to be able to survive. So how small business fares through all of this is something we're going to continue to want to watch. And then remember, with all those small businesses are jobs that were associated with them. So again, we'll watch this very closely. U.S. manufacturing index, we can see when it's above 50, we're in expansion mode. When it's below 50, we're in contraction. You can see with the pandemic, it dropped way below 50, and now has kind of recovered. We're now sitting around 53, 54, so it's back in expansion territory. So that's a good thing. And then the same thing with the non-manufacturing index. Took a big dip, now rised above 50, sitting around 56, 57. So again, in expansion mode. So that is a good thing. This is the S&P 500, the PE ratio. This is just the price of the market compared to its earnings, that multiple. I shared with you earlier the price to sales, the price to book. This one's now the price to earnings, right? This is the actual revenue of the companies. Historically, it's always traded around 16, 17 times earnings. You can see over the last 5 years, it was hovering, right around 22, 23 times earnings. And a lot of folks felt like, it could sustain that because of the low interest rate environment we found ourselves in. But folks, look at this of recent now. We got up to 30 times earnings. There's been a little bit of a drop, but still, the price to earnings here is very, very high. Now, when you look at these price to earnings, you're looking in a rearview mirror, you're looking at earnings the last 1 year. If you look at this, looking forward, okay, if all these companies hit their expectations over the next year, okay, where we find ourselves in the market at the end of September is that the PE ratio is maybe 22 times earnings, getting closer to where we were averaging probably the last 5 years. So from that regard, if these companies hit their expectations, you can't necessarily say we're necessarily in bubble territory, but we're certainly, at the top of the valuations. What's gonna drive that? Certainly, the only thing that can drive that is if the expectation, if the actual revenue exceeds those expectations or estimates. So. Just looking at some of the other indexes with the PE ratios, you look at the Russell 2000. Now, this is scary. A year ago, it was 41 times its earnings. All right. Now, the Russell 2000 is indicative of small company stocks. Okay. But look at the estimate, that next column. Right now, with what they expect earnings to be for small companies in the next year and where the price of those stocks are right now, it's at 92 times earnings. Folks, that means that somebody buying those small company stocks are only expecting basically a 1% return on their investment. I just don't know how long or sustainable that is. And then look at the NASDAQ at 34, almost 35 times earnings. Now, for tech stocks, that's not unusual. They tend to be a little bit higher than the S&P 500 as a whole. But look at it looking out, estimating it out maybe 1 year from now, 30 times earnings. Again, frothy territory, but not necessarily in bubble territory. But look at the S&P 500, now trading at about 35, times its earnings. Expectation, like I said before, if they hit their estimates, 25 times earnings. So everything, for the most part, fairly frothy. But again, I'm looking at what are those tailwinds other than just increased corporate earnings. Speaking of earnings, what's been driving the market is earnings. And you can see that over the last 10 years, that was steadily on the rise. But now with this pandemic, it's literally, dropped 20%. Now, I dare say that, we've had the market going up through this, hitting new highs, yet earnings are down 20%. There's a huge disconnect here, okay? One of two things got to happen. Those earnings got to come up to meet those valuations, or those valuations got to be adjusted down to meet the earnings. So what is the forecast earnings? Well, here's the Fed's projection just over the next 3 years. For the most part, flat, folks. So, unless there's some great recovery in this pandemic or something, like I said, happens that gets us even in a quicker recovery than we even has estimated, it's looking like this is going to be a slower comeback than a lot of people, thought it would be. This is just the VIX rate, or what we call the fear gauge. It's just an algorithm to basically estimate what they think the market's going to do in the next 30 days, to the good or bad. So a VIX rate of 20 means they think the market could do 20% the good or 20% bad in the next month. So it's just how wide the path is. It's historically been around 20 times. Right now, it's shot up during the pandemic. It peaked out, got up around 80. Now, at the end of the quarter, was sitting around 26. So not a ton of fear out there. That's not too far off what would be considered healthy at the end of September anyway. Treasury rates. Unbelievable. You look at the 3-month, 6-month, 1 year, 3-year treasury rates, all under 0.2%. And then you don't even get above that till you get to a 5-year. The 10-year treasury rate's like right around 0.7%. And then if you want to give the government your money for 30 years, they'll gladly pay you just a little over 1.4%. Folks, I never thought I'd see interest rates this low. And then basically looking at what the Feds are doing, they're going to try to keep these low for some time. If they see that the long-term rates are going to spike, they're talking about basically fixing those. That's probably the last arrow they can pull out of their quiver, to try to control what's happening out there. But, low interest rates are good if you're trying to borrow money, but, not good if you're a saver, right? I thought this interesting. The majority of U.S. young adults now live with their parents. You go back to the last Great Depression, back in the 30s, look at this, 43% were living with their folks. You go to the 2008 credit crash, 44% were living with folks. Today, 52%, better than half of them, are living with their folks. What's that tell you? That means they can't make it out there on their own. I've talked about this before, there seems like real, purchasing power has been lost over a long period of time. Young folks just can't get out there with these low-paying jobs and make ends meet. So they're living with their folks. I've shared this with you before. There's three stages in a bear market. You've got that panic selling. Well, we saw that in March, right? Dropped 34% in a 2-week period. And then you get this period of time where people are buying the dip, kind of up and down and go, and we kind of watch that kind of play out now for some time. Dare say we'll probably see a little bit of that happening after September, even when it kind of pulled back. But eventually, like I said, when that disconnect breaks finally between the reality of what's happening fundamentally and the market, when those come back to meet each other and that reality hits, and most likely will what I believe is totally speculative is going to fall back. It's when you get to the end of a bear, it's when everybody is kind of lost hope. It feels like the market's never going to come back. Enough people have gotten beaten up by it that they're in kind of despair mode. That's typically when you come to end, and that's usually a good time to get in. So, but we're hardly there yet. And how I know is this is Citigroup's sentiment gauge. You can see at the end of August, it was in euphoria stage. And then what did we see happen in September? So I don't know what the trigger is going to be. The feds could pull a rabbit out of their hat. Maybe the government comes up with some more stimulus money and they can add some legs to this. So it might take a little bit longer. But I dare say that there just tends to be a lot more concerns out there, a lot more things that can make this market pull back than there are drive it forward. And so, our posture is going to continue to be, very, very cautious at this point. There's a lot of concerns. I think we're entering now what could be a second phase, a second wave, I should say, with this coronavirus. We're seeing bankruptcies on the rise, unemployment. Where's that going? What about those permanent jobs that are lost? Is that going to continue to grow? You got social unrest happening in the cities. It's the election. As we approach this election, it's getting very volatile. And then you got these China trade war tensions, and the rise of nationalism globally. Countries basically just trying to take care of themselves. There's just so much uncertainty out there, a lot of concerns, that bring a lot of headwinds, as far as driving this market forward from here. But like I said, we'll see if this maybe gets a little longer legs to it by whatever the Fed does. So. I thought this interesting. This was some evidence that the market had become overvalued. This is just the rise in merger and acquisition activity. Now, why could that be a concern? According to this author in this article, he was sharing that, with money being so cheap, why don't companies, if they're acquiring other companies, just go out and borrow? All right, it's really cheap right now to borrow. But what you're finding is that, based on these percentages reaching almost 23, 24%, these last few years, is they're using their own shares of stock to do it. Why would they do that? Well, this author was pointing out that it's most likely because they know their stock is probably a little overvalued. And they're thinking, well, at these highs, we might as well use our own stock to, do these acquisitions versus borrow. So can you see that? With that, folks, I just want to thank you for joining us. If you have any questions, you can just call our office, talk to the advisors. We'll be glad to answer any questions you have. If you have any concerns as well, let us know. So with that, I'll end. Thank you very much.